Oh, hello there. I didn't see you walk in. Welcome to Rational Investing. My name is Cameron Stewart, CFA, and we're going to review SBUX Corporation. Behind me is their most recent 10K, their annual filing with the SEC. This was published September 29th, 2019, and it's a review of their annual performance. We're going to go through it, and we're going to value the company based on two methods. First, it's a free cash flow to equity holders method. Second, a market multiple, using enterprise value to EBITDA to value the business. We're going to look at these two, and then we're going to join them and look at the stock price in the market and figure out, do we think this is a fair value for the company or not? Now, I find looking at the business on your own first, coming up with a value, and then looking at the market is the best way. If you look at the market first, whatever you see is going to be in the back of your mind, and you're going to try to push that value into your analysis. Looking at it this way gives you determines what you would pay for the business yourself first and foremost, and then look to the market to see if it's worth buying or not. That's what we try to do. That's what we do here. That's what I hope you do at your home. And that's why we're investing in this company. So, before we review SBUX, let's go through some hallmarks of what we consider to be a solid investment. Number one, top-line revenue growth. Number two, earnings growth. Number three, solid cash flow. Number four, solid balance sheet. Number five, well-priced. Let's dive into this. The first statement I want to look at is the income statement. Income statement is on page 44. So we're going to skip down to 44 on the 10K. And that's the cash flow. Up, we're going to go to, here we go, income statement. So the first thing we want to do is look at top-line revenue growth. Top-line revenue growth is right here. You can see total net revenues, 22 billion, 25 billion, 27 billion. Top-line revenue growth. Moving forward, we're going to go to the cash flow statement because what we're ultimately interested in is the cash flow the business is producing. So here we're going to go to the cash flow statement. As you can see, cash flow statement. We're going to pick, there's three sections of a cash flow statement. There's the cash flow from operations, what they generate from the day-to-day from selling coffee. There's the investing cash flow statement. So what do they do with the free cash that they generate? And then there's the financing sections. How do they pay for it? We'll look at all three. We'll pull a couple data points of each, and we'll put them together. Here we go. The first statement we want is the cash flow from operations, and you're going to pull a particular line, which is the operating cash flow. And you can see it, let's see, cash flow provided by operations, right here. $5 billion in 2019, $12 billion in 2018, and $4.2 billion in 2017. I know what you're asking. How do they go from $4 billion to $12 billion in a year? What's going on? Well, it's a trick. It's an accounting change that they made. It's right there. A positive $7 billion. What for? Deferred revenue. What does that mean? This is basically a change that the accounting rules for gift cards. All the gift cards you buy in the supermarket, well, when you go buy one at a store, that money, that cash goes to SBUX. And the accounting rules said, hey, you got to recognize that as a liability because at some point that customer is going to show up to your store and say, hey, I got this card, you got the cash a while ago, give me my coffee. So that's a fair trade. But what they're doing is they're plugging it all in 1 year because they're trying to get caught up with the tax law, and that doesn't really represent how the business runs day to day. So what I'm going to do is I'm going to normalize this by subtracting this number from this number to get a levelized cash flow from operations. You'll see that in a second. Let's keep going for the rest of the statement. Let's get some CapEx. What does SBUX pay or invest in new stores, in new furniture, in building out future stores or remodeling existing stores, or even corporate infrastructure, computers, laptops for management teams, building new corporate headquarters, these large capital investments that are required to keep the business running. We want to know what those are. Additions to property, plant, and equipment. 1.8 billion, 1.9 billion, and 1.5 billion. This number needs to be subtracted from this number to come up with the cash after the business has reinvested in itself. After that, we go to the third statement, cash flow from financing activity. This, what we're looking to do is we're looking to figure out how much debt is the company taking on or taking off. What are they doing? How are they financing this growth? How are they financing what they're doing? And here, Starbucks does a great job. They break it out for us. You can see proceeds from the issuance of long-term debt and repayment of long-term debt. And we're basically going to add these two up each year. So they can either take the free cash flow and you can use it to buy down debt. You can go the other way. You can borrow money, and that cash could be distributed to shareholders. Think of it like if you own your house outright and you go to the bank and say, give me a loan on my house, I want to build a spa or I want to go buy a business. It's money that you can get your hands on. It's yours, and you can do with it what you want. So we need to add that into our equation. This is 10 years of free cash flow for Starbucks. And this bottom line in 2019 was the row that we were just reviewing, okay? So I was pulling the $5 billion of operating free cash. I'm subtracting the 1.8 of investment in new businesses, and I'm adding the 1.6 billion of debt that they issued in 2019 for a free cash flow of $4.887 billion. That is a lot of check. And what's cool about it is it's grown over the decade. Look at this. This is what 10 years will give you is perspective. And if you're investing for the long term, you need perspective. They started at about, call it $1 billion of free cash flow earlier in the decade. They're at $4 billion now. This is $8 billion, even higher. So there's a significant amount of free cash flow there that they have done an amazing job growing their company. Shares outstanding have basically doubled. Free cash flow is up 4 times. That's a beautiful deal. What does this mean for us? So if you bought a share last year in December, I'm using the year-end December numbers for each year, you would have paid on average of $92 a share. That $92 a share as compared to the $4 of free cash flow to equity per share. Now let me back up. How did I get that? 4.8 billion divided by shares outstanding is $4 a share. Very simple. You buy one share at $92, you can expect $4 of free cash flow to equity. And that's money that they could, again, buy back shares in the free market, which is a way of giving you, the shareholder, a dividend without taxing it. They're just shrinking the shares outstanding, which means you own a greater percentage of the company afterwards. Or they could dividend it, in which case you pay income tax on that, but you keep the cash right away. This is our effective dividend yield, if you will, effective dividend, if you will. $92 is the share price. Yield. I'm dividing $4 by 92 and I get 4.3%. That's your effective yield. Think of it like an interest rate. If I'm a stockholder, the business produces enough cash, it yields me about 4.3% last year. What the business chooses to do with it, that's up to them. But if they were to just dividend all of it to me, that would be like getting a stock with a dividend yield of 4.3%. And you can see that 4.3% has varied over time depending upon how profitable the business was, what the share price was at the end of the year. And I'm showing a growth rate to give you an average over the decade. They have grown that yield at 38% a year annual. That's incredible. That is fantastic to see that sizable double-digit number over the decade. It's rare in a business, and I'm glad to see it here. So then how do we take this and we come up with a valuation of what we think the business is worth? We're going to do that in a second. We're going to pick up this number here, $4. We're going to grow it at a growth rate over time. I'll show it. I have it right over here. Here we go. Free cash flow equity in 2020. So I'm taking the $4 and I'm growing it at 12%, 12.8% to be precise, and I get $4.51. I repeat the pattern over time, and I get $8.82 in a decade from now. Now, next year, 2020, is free cash flow to equity going to grow at 12.8%? Probably not. I don't know what coronavirus is going to do, but it's probably not going to hit this number. Okay, but over the average for the decade, Starbucks needs to have 8.3% growth to hit this number, and I think that's reasonable given the 38% they experienced the previous decade. The next decade, asking for 8% doesn't seem outrageous. In fact, I think that's conservative. So, I grow this number, average 8%, I get this number. Now what do? Remember that yield that I said? This number, 4.7%? This yield, I'm dividing it into 8.82%, and I get a stock price of $190 a share. That's the estimate for what I think Starbucks stock is going to be worth a decade from now. Cool. We can check that to the market, see if we're above or below, or now that we have an understanding of what we believe the stock is worth, checking with the market and see where we are. But before we do that, we are going to do one more method of valuation. Another method called the enterprise value to EBITDA method, so that we have two different ways of looking at the business. One is free cash flow, one is a market multiple method. EBITDA, let's get EBITDA. I'm still waiting for this thing to load, it's a little slow. There we go, it's here. Here we go, now we're back. So, let's get EBITDA. We're going to get EBITDA by starting with operating income. Operating income can be found in the income statement. Again, I'm pulling it directly from page 44 of the income statement, which is, let me find it, right there. $4 billion of operating profit. Now, little trick here. If you notice this line, this says income from equity investees. Now, that's not income from operating a coffee shop. That's income from other investments that they've made, and we don't want to count that. So what I'm going to do is I'm going to take the $4 billion and I'm going to subtract $298 million to come up with a net number. That's how I come up with this number right here. 3.779 is those two numbers, one subtracted from the other. Depreciation, I think we've covered this in other videos. Depreciation is a non-cash cost. And because we're using EBITDA as a proxy for cash flow, we're going to add it back. So you get operating income, which is basically earnings before tax and interest. You're going to add depreciation and amortization, and you're going to get EBITDA, earnings before interest, tax, depreciation, and amortization. That's going to be our proxy for cash flow. And it's a proxy that a lot of industry professionals use because it's easier to get to than doing the free cash flow analysis. And it's something you can relate one business to another much more easily. And they typically trade as multiples of EBITDA. You hear people talk all the time about this business is 5 times EBITDA, that business is 10 times EBITDA. That's what they're doing. It's a market method. It's a quick way of saying it's worth X rather than doing a discounted cash flow over a period of time. So we get our EBITDA. First thing we want to notice, growth rate, 2.2, 2.5, 3, 3.5, and so on to 5.2. Solid growth rate. Average growth rate 11.2%. Now that smell checks with the growth rate we're seeing from cash flow and equity. You want those two to be in line. If for some reason you looked at one as growing, the other one shrinking, that's probably an accounting problem, and you want to be careful for fraud. But in this case, they're both growing the same direction, one larger than the other, which is okay, but they're moving in the right way. They're both strong double digit. So now we have EBITDA. Let's get enterprise value. Enterprise value, we're going to begin with the long-term debt. So long-term debt is going to be, this says long-term and short-term debt plus pensions. If Starbucks had a big pension liability, like some of the aerospace industry, you'd want to include that here as well, but they don't. So you get the debt from the balance sheet. Let's go ahead and look at this really quickly. 46 is the balance sheet. So we'll scroll down to 46 right there. We'll zip over to liabilities, and you see long-term debt. long-term debt here, and you'll see current portion of long-term debt. That's basically this year's principal payment versus the remaining payment. In 2019, they had nothing that was due that year. The rest of it, $11.16 billion, $11.167 billion. So I've got the debt, cash. Cash is excess cash. So if you think about it, we got that free cash flow number that I showed you before. That's money the business has generated and can do with it what it will. It can buy back shares, it can dividend out, or it can store it on its balance sheet. If it stores it, that's what this number is. It's representing cash that was generated in prior periods that belongs to the shareholders but was never distributed. So what we're going to do is we're going to subtract this from the debt, as though if you bought the business today, bought everything, the shareholders would say, wait a second, that's $70 million. That was money that was generated during my ownership. Give it to me before you buy the business. So we want to subtract that. Market cap, shares outstanding times price. And again, I'm using the price at the end of the year, so average for the fiscal year, average for December, the end of the year. So here we go, December, enterprise value for the year, enterprise value to EBITDA. That's the multiple that we're looking for. This is how the business has valued, how the investment community has valued this business each of the last year over a decade. And it's got a pretty good range to it, 12.3 times. What does that mean? That means your earnings before interest, tax, depreciation, are proxy for cash flow. The business is trading at 12 times this number. Basically, if you bought it, it would take 12 years of this number to pay back the purchase price. Typically, the bigger the business, the higher this number. If you bought, let's see, a pizza place on your local street corner, that person might want 3 times EBITDA for the business because they're doing $100,000 a year, right? Here we're doing $5 billion. You're going to have a bigger multiple because it's a bigger business. Other things that can affect that number is growth rate. If you're growing tremendously fast, they're going to ask for a higher price. But for this company, 12.3, 23, averaged 19 over the decade. We're going to use this in our valuation in the future. And then interesting, debt to EBITDA. Here, what I wanted to point out is that this is growing. And you want to be careful about that. They went from essentially 0 debt to 2 times earnings in debt over a decade, which is important. That's a big move. It's not too much. You look for companies with less than 3 times debt. If you get 3 to 5, it can be a problem. Above 5, you end up being a struggling company. But 2 times this number in debt, $10 billion, is not, there you go, there's an $11 billion. Not that bad for them to pay for. So how do we value a company? We're going to pick up the EBITDA number. We're going to take this EBITDA and we're going to grow it into the future at our growth rate of 11.2%. And you're going to see that right here. Here's my 2020 EBITDA. Again, with COVID-19, probably not going to happen. But over the decade, they need to average 6.7% on this number to get to 9.9, just shy of $10 billion of EBITDA. If they hit this EBITDA, then you can value the company by taking 19 times that number, and you get an enterprise value of $190 billion. I'm using some average ratios to estimate what they'll have in debt and cash. Market cap of $180 billion, less the fully diluted shares that they have. Currently outstanding 1.22 billion shares, and you get $140, call it $150 a stock price. So there we go. Now we have a range. We've got $200 from a free cash flow method, and we have $150 from a market multiple method. What we're going to do now is we're just going to split the difference. I don't know what's going to happen. Is one going to be higher or lower? Who knows, right? We've got 2 different methods. I'm going to split it 50-50. $190 for one, $150 for the other. Call it $168 a share. Now what do? Now we get to look at the stock price that's publicly traded. As of today, it's $58. I'm saying it's going to be $168 in a decade. What does that mean on a return basis, and how should we think of this as an investment? So we're going to pick up the free cash flow that we already generated, and we're going to say, if I buy the stock today for $58, I'm going to get $4.51 for the year. And granted, there's a timing difference. We're in Q1 already. I get it. But over the decade, a lot of that timing issue is going to play out. What we're really concerned about is entrance point, cash flow, exit point. So for year one, I buy the stock for $58. I receive $4.51. I'm in it for $53.49. Over the decade, I get my yield. And when I sell the company, I sell it for $168 plus the $8.80 that I got in a dividend, and I get $177 of cash to me at the end of the year. That is a 22% IRR for the decade. That's a very good IRR. The S&P 500 will do about 15% in any decade period of time over the years. Here you're beating the market at 22%. A little extra detail, $68 will be your dividend. So if you're a retiree, you're looking for income, you could say, look, that's kind of the dividend I expect to get over the years per share. A gain, $110 would be the gain for a total return on the investment, or total money back on the investment, $178. For those of you who like a cash-on-cash return, 4x. So you put in $58, a decade later you would have pulled out 4 times your money, which is very, very good. So I think let's recap. Let's look at what our parameters are for investing. Top line revenue growth. Check. You saw it. Earnings growth. Yes, the EBITDA is growing at 11%. Cash flow growth. Free cash flow equity has been growing at 38%. Check. Solid balance sheet. Yes, they have low debt. They have cash on hand. They're well positioned. With 2x debt to EBITDA, it's fine. And then 2, well priced. $55 to get into the stock that could yield 22% over a decade seems like a very reasonable, in fact, very outperforming company. So I'm a fan of stock. Fan of this stock. Full disclosure, I already own it, and at this price, I'm going to be buying more of it. For us, if I'm going to give it a rating, it's good. Right? I love these things. So I think that's it. The other interesting thing, here's some fun math for you. If you go to Starbucks every morning before your work and you buy a cup of coffee, let's say it's average $3 every single day, you go 5 days a week for a year. 5 days a week for the full 52 weeks of the year, that's 260 trips to Starbucks. You pay $3 each visit, that's $780. Here's a fun fact. If you bought stock today, you put $16,596 into Starbucks stock. That stock would yield you 4.3% that we saw before. That 4.3% yield would buy you a cup of coffee every single work day, not only this year, forever. So you'd be getting paid to go to Starbucks and support the company you own. It's kind of a cool fact. I like thinking of businesses in practical ways like that. So I'm a huge fan, hence the Starbucks Promotion Cup. But again, my name is Cameron Stewart, CFA. Thank you very much for joining me. This is a practical investor's guide for the intelligent investor. Thanks very much. Bye-bye.